This video is about credit support for equity commitment in a project finance transaction. Okay, so let's start first with the definition of a project finance transaction. A project finance is a method of raising long-term debt for infrastructure, industrial project, and public services using a non-recourse or limited recourse financial structure. This means that the lenders in a project, they only have access to the revenues for servicing their debts. And once the project is completed, then the asset, meaning that the project and also the rights will also be as a second collateral for lenders. So it's basically an off-balance sheet financing and lending. So imagine during construction, when the project is not yet operational, meaning that it's not generating any revenues, and also the asset is not yet fully operational either, and it's not put in place. So imagine in that case, lenders, they don't have much to hang on to if things go wrong. So that's why they would still ask from sponsors to give some level of support and some guarantees. Previously, I talked to you about the contingent equity as a guarantee required by lenders for the completion of the construction. And I have a separate video, blog post, and Excel template, and I invite you to go and check it out. But today we're going to talk about another guarantee, which is the credit support for sponsors' obligations. Okay, now let's go and look at an extract from a real loan agreement on this credit support obligation.
A credit support for sponsors' obligations. The sponsors, to the extent they have not fully funded their respective equity commitment at financial close, shall procure the delivery of a sponsor credit support to the facility agent no later than financial close and shall maintain a sponsor credit support at all times thereafter until its obligations. Credit support obligation, entitled any obligation, to provide or establish credit support for, or on behalf of, a party to this contract such as cash, an irrevocable standby letter of credit, a margin agreement, a prepayment, a security interest in an asset, guarantee, or other good and sufficient security of a continuing nature.
Okay, now let's just simplify this, and I'm going to tell you a story. Through a story, I'm going to explain to you this topic in more detail. But before I tell you the story, I want you to know that any contract, whether it's a loan agreement, it's a concession agreement, whether it's a marriage contract, any contract is because of some insecurities that we have, right? So within the contracts, all the clauses and all the agreement is just because either some party is trying to shift one risk to another party, or is just trying to protect themselves from something or an action or a decision of the other party. This one is basically based on this insecurity of protecting lenders, protecting themselves from the action of sponsors. That's why they require this security from sponsors. Let's go now and listen to this story. An investor goes to the bank and asks them to co-fund a project with them. Sponsor: I want to build a power plant. My team did the studies and we need $100 million to complete it. The banker: my team reviewed your financial model and we can give you 70% of total project cost, meaning $70 million. Sponsor: perfect. Banker: okay, do you have the remaining $30 million? Sponsor: yes, but not at once. I can inject my equity as we progress with the construction work together with your debts. Banker: how do I know that your funds will be available 6 to 12 months down into construction? Okay, let's pause for a second and I will tell you what the sponsor is meaning when they say let's contribute pro rata with debt and equity. Because there is a possibility for investors not to commit all their equity upfront at financial close, lenders require credit support from sponsors to guarantee their obligation. To understand this topic, you first need to understand the different equity injection possibilities. I have a dedicated blog post where I explain 6 different equity injection possibilities. In our story, sponsor is asking the lender not to contribute all his equity upfront, but rather contribute gradually throughout the construction phase. And lender's concern is to make sure that funds required from sponsors are going to be available at any point in time when needed. So we left the story where the banker raised concern that if the sponsor don't put all the money up front, then whether the money is going to be available or not. So basically the banker is asking for guarantee from the sponsor. Okay, the response from sponsor is, I can guarantee in form of a letter of credit. Will that work? The banker says, okay, we have a deal. And they shake hands and they sign the contract and close the project. Now I hope if you go back and read that paragraph from the loan agreement or any other loan agreement, if you have such a clause on this guarantee, you can understand it better. Okay, the last thing that I want to discuss here before we go into the Excel and the financial model is the commercial consequence of such a guarantee. So far we talked about the project, which is an SPV on its own. So we have a sponsor and we have a lender. Now, because of this guarantee and because of this LC, the sponsors, they need to go to an LC issuing bank and ask for a letter of credit. And the next question is, who is going to pay for the LC fee? Is it going to be paid from the project account, from the SPV level, or is it going to be paid directly by the sponsor's own money, private money, not from the equity that they are putting in this project? So this is the question that is also going to be subject of negotiation between lenders and sponsors. So now that we cover everything, we're going to go and look at a financial model and see how we can model all this in Excel. Okay, let's now get into Excel. This is a typical financial model and I am in my input sheet. I'm going to go in my financing section. I'm going to introduce a new section for the inputs that I need and I'm going to label it undrawn equity LC fee. So the inputs that I need here is basically the fee. First of all, the percentage per annum fee that is payable on the LC, nominal amounts. And then I also might want to include the number of days for LC calculation. Sometimes it is based on 360 days and sometimes it is based on 365 days. So I want to bring in that flexibility as well. So for the LC fee, I'm going to assume for now an annual rate of 2%. This might be high, but let's assume 2%. And let's use 360 days for the calculation of fees. Now, the last thing that I want to mention in my inputs is the option that I told you, who's going to pay the fee. So I'm going to basically introduce a switch in my model. And the switch is going to say the undrawn equity LC fee payable by SPV. So if this is true, meaning that the LC fee is going to be paid from the project account. And if this is false, this will be paid by the holdco level. So I'm going to introduce as a switch, and here I want to show you how you can insert a button using the developer tab. If you don't have a developer, you need to go to your customize ribbon and make sure that the developer tab is checked. This way you have the developer tab in your ribbon. Now we go to insert on the ribbon and we get the form control, the checkbox here. So once you have it, you want to change it as well. This is a little bit tricky, but you can make it. Just rename it. I'm going to rename it undrawn equity LC fee payable at SPV level. Okay, so the next thing I want to do a little bit of formatting as well. So under format control, I'm going to just maybe highlight it and put a yellow background. And the most important thing to do is now to just put the under control, the cell link. So the cell link, okay, so make sure that when you are linking the cell, you go zigzag so that you can basically import this button everywhere else in your worksheet. Okay, now that we have all the inputs, we're going to come in any of your worksheet where you are doing the financing calculations. So in my model, I have this financing sheet, and under equity, I already have an equity account. So underneath that, I'm going to come and introduce this LC fee. Okay, so I'm going to bring in the inputs that I need next to my calculation blocks. It's going to be easier to audit as well. So reformatting. And so the first thing that I want to do is to calculate the LC fee on periodic basis, because remember we introduced the fee on annual basis. Now we want to make sure that the fee is calculated based on the periodicity of the model. Here it's quarterly basis, so I'm going to have a percentage per period. So I'm going to take the annual fee, multiply it by the number of days in each model period, and divide it by 360 days, which is an input in my model. So but automatically, whenever I divide something with something, I make sure that I have this check in the model with an if function, that this I will never have a divided by 0. So that's just something that I do automatically. Whenever I divide, I include an if formula. Okay, now that we have the percentage fee, now we can calculate the dollar amount. So it's going to be that fee multiplied by the equity available balance, right? So this is basically the undrawn equity. I already sized my equity. This is 30% of total project cost. And at each moment in time and each point in my construction, I'm going to calculate the equity available balance. So once I have that, so I can just easily calculate the undrawn equity LC fee. Okay, now the last thing is to basically bring in the switch from the input sheets. And now I'm going to calculate two lines. One is going to be undrawn equity LC fee payable by the SPV. So that's just going to be the line that I just calculated multiplied by the switch, and I'm going to fix it and drag it across. And the next thing I want to do is to say, okay, if it is not paid by the SPV, then who's going to pay it is a sponsor, right? So I'm going to come and create another label, payable by holdco or at holdco level or by sponsors. Okay, and this is just going to be what I calculated minus the SPV, whether it's paid by SPV or not. So as you can see here, this is 0 because it's paid by the SPV. Now let's look at how I'm going to basically link this in my model. The one with the SPV is going to go directly in my sources and uses of funds, right? Because it's paid by the SPV, so it's going to become part of the total project cost. So I'm going to make the link and I'm going to copy it across. Okay, so this way the SPV is going to be this cost, this LC fee is going to be part of the total project cost and funded by debt and equity. I have a copy and paste macro. I'm just going to run it. If, however, this switch is to false, meaning that this is paid by the at holdco level, so now this is off, as you can see here. So now we will see that the SPV level is 0 and the line that it's paid by holdco level is basically 406K. So now we're going to come to our where we do the equity IRR calculation, and this is going to be an outflow for the sponsors. It's going to come from the sponsors pocket, own pocket. So we're going to bring it into our IRR calculation, and as you can see, I'm just going to copy it across. And I'm going to make sure when I'm calculating the net cash flow to equity, this is an outflow to the equity and to my shareholders in this model. Okay, so remember, so as you can see here, we are starting with a 16.3% IRR. It went down to 16%. Okay, so now you see in the summary sheet, I can go and copy. That's why we did the zigzag, remember? So I can easily copy it, paste it here on my chart, and look at the difference between the IRR if I pay the LC fee at SPV level. So as you can see here, it's 16% if it is part of the total project cost. Okay, just remember this, I have a copy and paste. So I attached it to the switch. So I don't need to run that button anymore. Automatically, when I do check and uncheck, this is basically done. The other thing that you want to maybe experiment in this model is to look at the different drawdown schedule and the impact on the IRR. This is what I covered in my previous tutorial and video. However, both of them together, you can also have an idea on the difference between how you're going to draw down on equity and the impact of this LC fee being payable at holdco level or at SPV level. Okay, so I also have a blog post that covers the things that I covered during the video and more. Go ahead and check it out. And you can also download the demo file and play with the model by yourself. Okay, so that's it for me. I hope you like this video. If you like such a content, please consider subscribing to my channel. And I hope to see you in my next video. Thank you and bye. If you want to learn how to build better financial models, check out my online course on financial model spreadsheet design at courses.phoenixmode.com.